Welcome to the Daily Update Podcast, where I'll go over the action in the market for Friday, September 5th, and we'll see how things look for Monday, September 8th. The big event on Friday was the release of the U.S. employment report, which came in weaker than expected, solidifying expectations for a Fed cut. Economists had anticipated 78,000 non-farm payrolls, but the actual figure was a mere 22,000. Private payrolls also disappointed, coming in at 38,000 against an expected 90,000. The unemployment rate ticked up to 4.3% from 4.2%, and revisions to prior data were mixed. The underwhelming report has cemented the likelihood of a 25 basis point rate cut at the Fed's next meeting, with additional cuts expected through the end of the year. While the economy remains resilient, bolstered by strong ISM services data, for example, that was released earlier in the week, the Fed appears poised to fine-tune monetary policy rather than respond to a collapsing economy. A stronger-than-expected report could have justified maintaining higher rates, but Friday's data has tipped the scales firmly toward easing. Switching over to market performance and technical analysis, the S&P 500 opened strong, climbing above R1 at 65.21, but a buy the rumor, sell the news reaction led to a sell-off. The index dropped below the daily pivot at 64.84 and S1 at 64.65, finding support at the 20-period moving average, which also coincided with 64.50. The S&P closed slightly below the daily pivot, down 0.32%. Trading volume was above average, reflecting higher participation after the employment report was released. While the S&P 500 set an intraday all-time high, it failed to achieve a closing high, settling below the 6,500 level. The Nasdaq, however, reached an all-time intraday high as well, though the Nasdaq 100 lagged, signaling underperformance by large-cap stocks. Meanwhile, small and mid-cap stocks outperformed the broader S&P, likely benefiting from expectations of lower borrowing costs due to anticipated rate cuts. From a technical perspective, the S&P 500 remains positive across all time frames, holding above the critical long-term resistance level at 64.68. However, short-term indicators are mixed. The CCI 20 and Stochastic show positive conviction, but the Chaikin Oscillator and Sean Trend Meter, while still elevated, are declining. Momentum is also mixed, with some internal charts positive and others negative. The VIX remains below 20, with no significant seasonal spike, at least yet. Looking at interest rates and other assets. Beyond stocks, we saw notable movements in other asset classes. The 10-year Treasury yield continues to drop and settled at 4.09%. Just a few days ago, the 10-year yield was at 4.28%. This could be providing a tailwind for stocks. The U.S. dollar continues to weaken and oil prices continued their decline, pointing to subdued inflationary pressures for right now. These dynamics align with the market's expectation of a more accommodative Fed policy. Looking at sector performance and investor sentiment, the financials, energy, and large-cap tech stocks, including Nvidia and Amazon, underperformed this week. On the other hand, communication and some tech stocks, including Google and Meta, along with the small and mid-cap companies, showed relative strength in Friday's session. The financial sector to S&P 500 ratio is back to weakening, which may signal underlying economic concerns among investors. Overall, market sentiment remains neutral. Despite the intraday all-time high, investors appear cautious as the S&P 500 short-term conviction is lacking. However, it's holding above the 64.68 long-term resistance level, which will be critical for sustaining the bullish trend. Looking ahead to Monday, September 8th, investors should keep an eye on upcoming economic data. Consumer credit will be released on Monday, followed by PPI on Wednesday and CPI on Thursday, and then consumer sentiment on Friday. Inflation data in particular will be pivotal as it could shape the expectations for the Fed's future policy moves. Historically, September is a challenging month for the market, though we've yet to see significant weakness in 2025. The first half of the month typically outperforms the second half of the month, so investors should remain vigilant. Key levels to watch include the S&P 500's ability to hold above 64.68 and any surprises in the upcoming inflation reports. In conclusion, the S&P 500 remains positive across all time frames, but the weaker than expected employment report has reinforced expectations for a rate cut, likely starting with a 25 basis point reduction. Small and mid-cap stocks are benefiting from anticipated lowering borrowing costs, while falling bond yields and declining oil prices suggest limited inflationary pressure. However, mixed technical signals and cautious sentiment warrant close attention to next week's inflation data. Thank you very much, and I will talk to you in the next podcast.